Could Trump's victory drive inflation higher and complicate the Fed's next moves? With German politics in turmoil, how will Europe's biggest economy weather the storm? And what's behind the S&P 500 and Nasdaq hitting record highs yet again? Welcome to The Daily Show, where we take a look at the latest economic news, market data, and stock market updates. Let's get started. The Federal Reserve has cut interest rates again, trimming its benchmark by 25 basis points to land at 4.75%. This move isn't too surprising, as the market priced it in with a 96% chance. Still, it raises questions about where rates are headed next. Fed officials cited ongoing growth and a resilient labor market, but they also noted that job market conditions have eased, which was their objective when they began hiking rates aggressively to control inflation months ago. Unemployment remains low, but recent strikes and hurricanes have clouded the picture a bit. Inflation has been stubborn, too. While the Fed's preferred inflation measure, the PCE index, hit 2.1% in September, right near their target, core inflation, which excludes volatile costs like food and energy, is stuck at 2.7%. It's been holding steady there for months, complicating the Fed's path forward. Today's rate cut was largely expected, but the language in the Fed's statement suggests a cautious outlook. They've stopped emphasizing further progress on inflation. This subtle change leaves the door open to a possible rate pause in December. In the press conference, Fed Chair Jerome Powell said he wouldn't resign if Trump asked him to. If Trump's economic plans push inflation higher, as economists expect, the Fed's job could get a lot tougher. U.S. weekly jobless claims ticked up slightly, with 221,000 new claims filed last week. It's a modest rise, but it adds to concerns about wage pressures. The latest data shows labor costs jumped significantly last quarter, sparking worries that inflation could remain sticky. Paul Ashworth from Capital Economics put it plainly, quote, "Unless unit labor costs growth slows, it'll be harder for the Fed to claim that inflation is sustainably at 2%. End quote. So, while job growth remains steady, the cost of labor could keep inflation on the Fed's radar as we head into the year's final months. In Germany, Chancellor Olaf Scholz is under intense pressure to call new elections following the collapse of his coalition government. This political shakeup comes at a critical time, as Europe's biggest economy faces a second year of recession, along with mounting global uncertainties following Donald Trump's recent re-election. The coalition fell apart over disagreements on filling a multi-billion euro budget shortfall, with Scholz dismissing the finance minister from the FDP. This departure prompted the FDP to quit the coalition, leaving Scholz's Social Democrats and the Greens to lead a fragile minority government. Scholz has proposed a confidence vote in January, but the opposition leader from the Christian Democrats insists the vote should happen next week. Business leaders have echoed this urgency. Dirk Jandura of the German wholesale lobby BGA said, quote, "Every additional day with this federal government is a lost day," end quote. He emphasized that Germany needs new leadership to address economic challenges without delay. Adding to the strain, German borrowing costs have spiked, while exports and industrial production remain weak. German industry has struggled since COVID-19 and has suffered further due to competition from China and Russia's full-scale invasion of Ukraine, which cut gas supplies from Russia to Germany. If Trump follows through on his threat of tariffs on EU goods, it could further shake Germany's economy, as exports to the United States account for around 3.8% of German GDP. Let's dive into the macro and market data to cover trends and insights. Historically, stocks haven't performed as well under a Republican sweep across the Senate, House, and White House. Annual performance varies widely, with an average gain of 6.7% and a median of 6%. While it's a small sample size and the House results aren't final, it's worth noting that a full red wave doesn't guarantee a major stock boost. Looking back, Trump's 2016 victory set off a rally where U.S. small caps in the Russell 2000 outperformed large caps by almost 9 percentage points from election day through year-end. We're seeing a similar pattern now, with the Russell beating the S&P 500 by 3.3 points just yesterday. This trend makes sense, as small caps typically benefit more from interest rate cuts, given their higher interest expenses as a share of total debt, currently sitting at 7.1% versus 4.2%. But be cautious about sector performance. While energy, financials, and industrials rallied after Trump's 2016 win. They ended up being some of the weakest sectors over his term. Energy, for instance, dropped nearly 50% by 2020. In contrast, tech and consumer discretionary led the way over those 4 years, proving to be the real winners, even though they didn't stand out right after the election. It's a reminder to look beyond the immediate rallies. Turning to IPOs, Trump's pro-business approach could open the door for more companies to go public. IPO volume has struggled under Biden, but with Trump's promise to cut red tape, we may see a surge in listings as soon as next year. The S&P 500 rally that started in October 2022 is yet to hit the average months and returns of past bull markets. An analyst from ICI projects a 6,600 target for the S&P by the first half of 2025. He describes the current bull market as still an infant, driven by deregulation policies expected in Washington. While valuations may seem high, what's expensive tends to get more expensive during bull markets. Historically, when the Fed cuts rates with stocks near all-time highs, the market has finished higher a year later every single time. The S&P 500 index has historically generated a median return of 4% between Election Day in November and calendar year-end. Goldman Sachs expects solid income growth across the income distribution next year, with an average increase of 2.5%. Despite concerns around inflation, geopolitical tensions, and economic slowdown warnings, real-world data tells a different story. Aggregate income has jumped 6.4% over the past 3 months, showing that underlying economic strength may keep the bull market alive longer than bears expect. We see this in Japan too. Japanese wage growth surged in September, with base salaries rising 2.6%, the highest increase in over 31 years. Bloomberg expects this trend to prompt a rate hike in January. In the American stock markets, we're seeing strong momentum following Trump's election victory and a fresh Fed rate cut. The S&P 500 rose 0.74%, while the Nasdaq surged 1.5%, with both indexes hitting new all-time highs for the second consecutive day. Driving this rally are investor expectations of corporate tax cuts and deregulation under the new administration, which are anticipated to boost corporate earnings. The Dow Jones, however, was flat after a massive 1,500-point gain on Wednesday, its best day since 2022. In contrast, the small-cap-focused Russell 2000 slipped 0.43% after a recent strong run. In the bond market, the 10-year Treasury yield dipped by about 9 basis points to 4.34%, cooling off after a sharp rise earlier in the week. Investors are balancing optimism about growth with concerns that Trump's policies could also drive inflation higher, keeping yields volatile in the near term. The Fear and Greed Index remains steady in the greed zone at 59, unchanged from yesterday. In yesterday's session, semiconductors and gold miners led the gains, both up over 2%. Technology stocks also showed strength, rising 1.74%. Meanwhile, regional banks struggled and went down 3.62% as financials slipped. This dip corrects the extremely positive move seen the day after the election, so it's likely just a short-term adjustment for these stocks. Oil saw minor fluctuations, briefly gaining but settling around $71.80 as Hurricane Rafael's impact on production lessened. Natural gas dropped 1.97%, trading at $2.70. Gold rebounded 1.1% yesterday after a big post-election dip, though it remains below $2,700 in early trading. Today, there's no noteworthy economic data or earnings releases, so we'll check what's coming next week on Monday. Please subscribe and hit the notification bell to stay tuned for daily updates. If you've made it this far, thank you, and see you on Monday.